Howdy there, folks. Welcome into today's video. It's been a while since I posted a video here on the Reaction channel. Thanks everybody for joining me. I think it's been about a week roughly, but today we got to buy one, get one free. Two very important videos I want to react to. This one came out about 2 hours ago. It's the revenge of high beta in growth stocks. So I want to hear what Joe at Terranova has to say here, and I want to react to that one and kind of give my opinion on, are growth stocks, is it finally comeback time? Do these ones still have a while to wait? We'll discuss that in this video. Second video I want to react to is the Fed tone deaf, which I think is a very important subject that we must discuss. And this one's out from 2 hours ago as well. And we'll speak about that one, kind of the Fed, my stance on that as well. Okay. So I just got back from vacation. First real true vacation I've taken, honestly, in years. Absolutely. It's been so long since I've actually done an unplugged vacation. I had an amazing time. Stayed at a place called Casa de la Playa. It was absolutely phenomenal. Amazing service, amazing property. Just really enjoyed myself, and yeah, just had a good time, recharged the batteries and all that good stuff. Also wanted to announce, if you didn't get to see my video earlier, we did basically start a Patreon. So if you enjoy the content on the channel and you want to support us, you can go ahead and check out the pinned comment down there. I made it affordable for everybody. It's $10 if you want to join. And essentially what I'm going to do is I'm going to buy stocks in the account. It's basically an account, a Fidelity account that I have set up with the Patreon. Every single Friday, I'm going to deposit $150 and buy stocks with that money and build up the portfolio over time, $150 every single week, and just show people that it's very possible to still build an account with a more modest amount of money, right? Because I know sometimes when I buy stocks in my main portfolios, it's really big dollar amounts usually, right? Sometimes it's thousands or tens of thousands of dollars. And sometimes it's even more than that, right? And it can seem like maybe the stock market, you can only have success if you have like crazy money or something like that, when that's just not reality. You can build up a phenomenal diversified portfolio with just $150 a week and deposit in that, investing in growth stocks, value stocks, dividend stocks, diversifying your portfolio well. And I'm going to show everybody that. So yeah, if you want access to that, I actually just bought my first group of stocks on Friday, and I got screenshots in there once you join the Patreon there, and you'll be able to see exactly what stocks I bought there and what stocks I hold in the portfolio so far. And then this Friday I'm going to buy more stocks, and the next Friday, and just keep it going, and just continue to build that portfolio, and hopefully get it to a place where eventually it's like a 5-figure portfolio and then a 6-figure portfolio over time. Okay. And I also want to give a shout out to the first ever Patreon we had in there. They literally joined within minutes of launching the Patreon, which is Tyler S. So Tyler S., thank you for supporting. You were literally like within minutes of me even announcing that, you were literally the first person to join. So thank you everybody also that's joined and supporting the channel through Patreon there. I appreciate each and every one of you. Okay. All right, let's get into it, guys. I hope you enjoyed as always. Thanks.
To rethink stocks in the near term, because the narrative has been you're going to have a tough near term, and then maybe you can have a good second half. And we've discussed whether maybe that's backwards, because the inflation data is starting to cooperate in a fairly substantial way.
Okay, so the way in which I'm personally invested, obviously, I want this to be a good first half of the year, but I am invested in a way where today I'm underperforming, because what is today all about? Today is the revenge of high beta. That's what's going on, right?
What that gentleman just told us there, this is very important for everybody watching this. What that gentleman just told us is basically what he told us is he's long what has been working in 2022. So that gentleman's still playing a game of 2022. Remember, these Wall Streeters, folks like this Joe Terranova, they think a lot of short term, and they're trying to position portfolios. You heard about him talking about, I hope the market goes up in the first half of the year, and maybe he can slide out of stocks in the second half or something like that, right? So they're always playing these things from short term perspective. It sounds like he's trying to play in 2023 the same thing that worked in 2022, but we know many times the same thing that worked last year doesn't work the next year, right? And so it sounds like what he's actually in is maybe a lot of value stocks. Maybe he's in the McDonald's of the world. Maybe he's in some of the oil and gas stocks and those sorts of stocks, right? And he hasn't positioned for growth. He's probably not positioned in a big way in Tesla and Amazon and many of the other stocks that are starting to perform really well, Meta, right? Maybe he is, maybe he isn't, but obviously based upon his commentary there right off the bat, you can tell he's really not positioned where he wants to be, given kind of this I guess you say sentiment change we are starting to have happen.
And it's interesting because if you study the three major indexes, you've got the S&P, and everyone looks at the moving averages, the 50, 100, and 200-day moving averages, okay? They're all kind of bunched on top of each other. They're stepping on each other. You look at the Dow Jones Industrial, well, the Dow is actually above all of its major moving averages, but it's the NASDAQ Guess what? The NASDAQ is still below its 50, still below its 100, still below its 200-day. So understand the environment of now. You could have further carry through based on where price.
This is where Wall Street just cracks me up, because basically what that gentleman's saying is, the market has to get above these certain moving averages, right? So basically the market has to do very well for a lot of these folks to start buying back in more aggressively, which means many of the indexes have to move another 3 to 5% from where they're at to move above these certain moving averages. So it's just funny how it works. It's such a pile-on effect, because if you're thinking like that, right, you need the market to go up certain. Next thing you know, it hits that range, and then you have to pile back in money, which makes the market go up even more. Now, the same way it works on the downside, right? When the market's getting bad and it's getting worse and getting worse, it's just the selling pressure just puts on more selling pressure. And we just reached under this moving day average. Sell, sell, sell. And it creates these sell-offs and these buys that, to be quite frank, many times in the short term, they don't make any sense. And that's, if you look at the indexes, they're moving like stupid amounts. Let's just put it that way. That's the most unprofessional way of putting it, but it's the truth. If you look at where the indexes moved from October 13th through the end of November, it was a double-digit percentage move. Ridiculous, okay? Then you look at the month of December. The NASDAQ was down double-digit percentage in the month of December. The indexes should not be moving that much. That's ridiculous. That's uncalled for. That shouldn't be happening. It is happening. And one of the big reasons this happens is because of the algorithms and the buying and selling based upon moving averages. And these stocks get way overbought. They get way oversold constantly. And it creates a market dynamic that, for long-term investors, is the best thing ever for us, because many times these stocks get not just oversold, but epically oversold to ridiculous ranges that you're just like, really? Like this stock is trading at this price? There's just a long list of stocks that, over the past, let's call it 3 to 6 months, that I've seen just trading at prices that's just like, I can't believe this stock is this price. But that's what happens. We have a market that's driven off of a lot of technicals, and you've got the machines doing their thing. It's what's going to happen.
Relative to those moving averages for the NASDAQ, for a lot of the high beta names, I'm not comfortable right now being in those names. I don't want to be there, but there could be follow through for sure.
You got a dangling earpiece. You do. You fix that right now, because if it's distracting to me, I can only imagine what the people at home are
They're
thinking
looking at my gorgeous
right now.
haircut.
It's like flying away on you. So fix that. We'll go to Liz Young. We'll help you out here and take the camera shot off you while you do that. So Liz, Tom Lee. I couldn't help but acknowledge it. It was like flying all over the place. So Tom Lee today says the first 4 days, right, is strong omen. He said it implies plus 23% gain. By the way, Tom Lee's on overtime today, so we're going to get down and dirty on that prediction for stock. But Steve,
I might have to react to that later tonight or something. Holy smokers.
Stiefel today says there's a window as well to get to 4,300 by the second quarter of 2023. What do you make of that? Sharply lower inflation, they say, a Fed rate pause, no official recession. Like I said, that plays into that opening question. Time to rethink the near term?
Look, I think it's possible and probable that inflation comes down pretty well in the first half. It might come down very, very quickly, and the market is going to cheer that. I think the move today, the move on Friday, was really predicated almost solely on the fact that wage growth relaxed. Mm-hmm. And we got this jobs data on Friday that kept the hope for a soft landing alive. The only thing I would caution people on is that the stock market and wage growth alone does not reset the economic cycle, does not solve all of the problems that we have. The risk of a wage price spiral maybe got reduced for a little while, but that doesn't mean that the risk is gone. And what we're seeing right now, especially in some parts of
wage price spiral, not realistic whatsoever. You're seeing it in companies. What are companies doing? Laying off. If you really had to worry about wage price spiral at this point in time, you would see it because companies wouldn't be laying off at all. And they would be having to, obviously give employees, 10% raises and those sorts of things. I can tell you people aren't getting those sorts of raises. And if you work for a corporation, you know exactly what I'm talking about. You might be lucky at a 2 to 4% raise this year, if you're getting a raise, right? And a lot of people are, instead of getting raises, are getting fired this year. And that's a tough environment that we're going to have to deal with in 2023. And you got even the strongest companies in the world doing that, right? The strongest companies in the world So I think that's just something to keep in mind. You know, you don't have the signs there anymore at this point in time of a wage price spiral whatsoever. And you likely won't, especially if there's more layoffs and unemployment starts to climb pretty significantly.
Labor market, definitely parts of the consumer data is that economic data is weakening. It's probably going to continue weakening, and we can't have it both ways. If you want inflation to come down, you have to bring demand down. That affects consumer spending. That affects corporate profits. I don't think we've seen the end of the bad news.
Okay. So Steve Weiss, I turn now.
True, and I agree with that. But here's the big point, folks. Okay, here's the big point, is the market is always ahead of this stuff. So while you will still get bad news, the market will have already bottomed. And now I don't know if the market has already bottomed or maybe we still got a bottom coming in a few months from now. That's a big debate, okay? And I don't want to even try to predict that right now, nonetheless, right? But what I can tell you is the stock market gets in front of this stuff. And so you'll see the stock market moving up, stocks moving up, before the bad news is even close to being done. I mean, we're talking 6 months, if not 12 months before bad news is done coming. You'll see the market moving up. No different than the economy was so strong while all these stocks were falling massively. Why were all these growth stocks and stocks in general going down 50, 60, 70, 80%, 90%, right? It was a complete revaluation, and it was the market obviously pricing in like some bad earnings potentially coming over this next year and those sorts of things, right? And a weakening economy. And so I think that's a big factor. The market is always, always ahead of everything.
Our resident hater turned day trader.
Only of you, Scott.
Turn day trader now, because Mr. Negative is actually looking for opportunity, it seems, in this market. You bought the S&P 500, the VOO, this morning. You bought Microsoft on Friday. We'll start there, and then we'll go further than that. But are you rethinking the near term for stocks? You must be in some sense if you did that.
You know, I think that I'm more appropriately categorized, again, with the exception of you, as not being a hater, but being somebody who likes to make money, yet not at the risk of losing money when I don't have to. So sure, you have to take bets, and there's always the chance you're going to lose money.
I don't know. This gentleman, I swear every single time I see him speak, it's always negative. And look at the name of his funds. Short Hills Capital. Come on, man. Short Hills? Come on.
For all the best investors
like a short
only
seller.
make or only right 60% of the time or so. But the market continues to look at single data points, and Liz just put it absolutely perfectly, much more articulate than I could.
First off, you should be right a lot more than 60% of the time over the long term. If you're a long-term investor and you're betting on stocks over the next 3, 5, 7 years, you need to be right a lot more than 60% of the time, maybe more towards 70, 80, 90% of the time. In the short term, you know, that 60% number could be realistic. Sometimes you can be more wrong than right in the short term. But if you're wrong, you know, that much over a 3, 5, 7 year span, that's way, way too much.
No doubt. As we've seen by both of us talking.
Go ahead.
But yeah, I agree with that. I agree with that. So the bull case rather was always, who doesn't know that rates are going up? So you got to buy the market. Well, who doesn't know that inflation's going down? And when you looked at the numbers on Friday, you saw one positive data point in a sea of negative data points in the current report, which was that you had jobs, better, higher, more jobs than anticipated. You had a lower job unemployment rate, but then you had some revisions, which sort of put me over the edge in addition to the wage number being slightly lower. So I said, look, the market's looking for opportunities to go up. It's still a trader's market. Part of my portfolio is long-term, but I'm also, I can trade. So Microsoft, as I look at it, Microsoft in these environments trades higher when things like this happen. When the market goes there, it goes to the big cap tech. It goes to reliable brand names.
That's interesting. Interesting perspective. All right, next up, Fed.
Of your report today, if you want to call it that, is the tone-deaf Fed, in part because there is a question as to whether the allegedly data-dependent Fed is really data-dependent at all, or if they've already made up their mind and set their destination and come hell or high water, they're going there no matter what.
I think it's the latter, Scott. I think that if you look at the statement in the minutes this week on last Wednesday, where they said no Fed official is forecasting a cut for 2023. I mean, that may be true, but how do they know that? How can they be so sure?
And that's interesting because I think there's a high probability they cut in 2023. I think there's probably, I'd put it, if I had to put odds on it as a Vegas odds maker, I would put it at 70% that they cut rates in 2023 and a 30% chance they don't cut rates in 2023. So it's interesting. None of them expect that as of right now. But, these folks, are wrong very often in the Fed. We've seen that before.
Fed official is forecasting a cut for 2023. I mean, that may be true, but how do they know that? How can they be so sure? Look at the SEP itself, the statement, the summary of economic projections. 17 of 19 officials over 5%. Mm-hmm. And then look at what they said last week. Despite the wage data coming in weaker.
But they kind of have to be like that, to be quite frank. They can't be out there and be like, oh, yeah, we're expecting to cut rates in 2023 because then the market's going to jump huge, on that sort of news. So to be fair to the Fed, they have to be super negative right now. Even if they do expect to cut at some point, they can't say it. They have to lie. Literally, they have to lie right now, even if they felt they're going to have to cut. They can't say that right now because the market jumps huge and then that makes their whole problems even bigger.
And most importantly, the ISM services data coming in showing contraction in that sector, no change in the rhetoric. I think they are in a forward guidance mode, a mode in which, Scott, they are going hell or high water to that 5% mark. They have a date with 5% rather than being data dependent and route to 5%.
Maybe we just should stop listening to what they say and pay more attention to what they do in the meetings ahead. That when a Bostic or whoever, Esther George last week come out and, respectively suggest, well, we're going to go above 5%. We're going to go 5.4 and hold it there for a while. I mean, okay, so what? That's what they say now. Why should we take them at their word?
Because it's the best gauge I think you have of what they're going to do.
Their word?
Yeah, I think that's what you have. I mean, I don't know. Do you have another thing to do, or
I think the data and the trends of the data is, in my opinion, a better gauge of what they'll actually do than what they are saying, because they're going to literally just tell whatever's going to keep the market down in the short term and what's going to keep financial conditions tight right now. That's all they're going to do.
Look at otherwise.
But when we say, the problem with that is, as what some have already said, is that, well, you can't take them at their word for this because they were wrong before. So let's just see what, in fact, they do. They got the transitory thing so terribly wrong.
That's right. And I think that's the issue right now, is that they're heading, it seems to me, the same kind of sort of monolithic, everybody on one side of the boat idea that they decided it was transitory. I'm just surprised they, A, haven't softened their rhetoric given the data, and B, that there isn't a broad range of opinions, it appears, on the FOMC. You look at what the market did, Scott. Look at the 2-year note from Friday. And those two steps down. One person talked about the wages earlier on your show. The other step down, if you look at that 2-year note from Friday, is that what happened with ISM. The market took that pretty hard in their sense of what the outlook is for the economy. We had inflation expectations come down. There's that two-step process there. You can see that shelf there in the middle on the way down. What does that look like? Is that kind of an Everest kind of thing? I don't know what if you guys have done any climbing or anything like that. And then it's actually trending down 420 again today, Scott. So the data has been weaker. The market is taking it that way. If you look at the spread of the market and the pricing for the probabilities in May, there's a number of opinions out there. There's not among the 19 members of the FOMC.
I mean, you say, I don't know why they haven't changed their language a bit, but in reality, we know. The reason they haven't done it is because they know that if the moment they do, the very stock market and the market in general, the stocks for certain, would take off immediately, and they can't afford to have financial conditions loosen any more than perhaps they already have and are, because that's what the immediate impact would be.
I think that's probably right, Scott. I do think, though, that the market is already doing what it's going to do, or has already loosened financial conditions in that regard. And if they want to do some damage, I guess, to the long end of the curve, they could sell bonds out that way. But I think the problem for me, Scott, is that they do not appear to be incorporating the considerable risk of recession. And what is not talked about enough is the effect of balance sheet reduction. They're going to do $1 trillion this year. They did $400 billion last year. I had a conversation with Bullard during a scrum with reporters last week, and I asked him whether or not his formulas. Remember that he has that range of 5 to 7%. I said, does that range of what the appropriate rate of the funds rate is incorporate balance sheet reduction? He said no. And I said, does that mean you're being over sufficiently restrictive? And he said, some could argue that.
Yeah, I mean, I agree with honestly a lot of that. But just I think the overwhelming perspective I want everybody to remember that's watching this video right now is the Fed has to, and I mean absolutely has to, keep the market in a scared, worried mentality right now, in a state that they believe that the Fed's going to hold true. They're going to keep the market in a position where they don't want it to go up. They don't want the stock market to go up. They don't want financial conditions to ease. They want to completely destroy inflation before they do that. So the Fed's are trying to do everything it can to keep the market down right now. That's the bottom line. That's the simplest way I could put it to everybody that's watching this video right now. The Fed is single-handedly trying to keep the stock market down and financial conditions tight. And they're going to try to do that as long as they can until something breaks or until like they get so much data coming in that it's like inflation is not really a concern anymore. And for right now, it's still a concern. 3 months from now, 6 months from now, 9 months from now, it can be a very different dynamic. But for right now, it's still a big, huge concern. So they have to keep things like, oh yeah, we're going to keep rates high for long, blah, blah, blah. Doesn't mean they're going to. It's just what they have to say right now. Even if it's a lie, they have no other choice. They can't say anything different, because the moment they start saying, oh yeah, we're thinking about cutting in a bit, or 3 months, 6 months at the end of the year, blah, whatever. As soon as they say that, the market's rallying. Huge. I'm talking 10, 15, 20% NASDAQ move, which means countless stocks are up 50, 100, 150%. Like that. Financial conditions ease huge, and you risk having inflation come back very quickly before you really got it down the way you need to get it down. And then you get into a potential 1970s situation where you have inflation come roaring back again, and the dragon really isn't slayed. They're trying to slay the dragon before they let things go, let's just call it, upward in a major way. They don't mind the market moving up a few percent here and there right now. But in terms of that next bull cycle, they don't want the next bull cycle to happen right now. They're trying to keep that next bull cycle as far away as possible. Maybe in 2024 they'll let the bull cycle start, and maybe toward the back half of this year, but they don't want that next major bull cycle to happen right now. 5%, that's fine. A 20% move? No, they do not want that right now for this market. Appreciate y'all joining me. Much love as always. Thank you every single person that's supporting over on Patreon who enjoys the content and wants to support the content. Also, I hope you guys enjoy being able to see all the stocks I'm buying each and every week in the portfolio in there. Thank you for watching and have a great day.